Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing AMC stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. AMC is the largest movie theater chain in the world, ahead of Regal and Cinemark. The company is headquartered in Leawood, Kansas, and was founded in 1920, over 100 years ago. It started trading in 2013 and can be found on the New York Stock Exchange, Mexican Bolsa, and Deutsche Börse. AMC was originally an abbreviation for American Multi-Cinema. After acquiring Odeon Cinemas, UCI Cinemas, and Carmike Cinemas in 2016, it became the largest movie theater chain with 2,900 screens in 360 theaters in Europe and 8,000 screens in 620 theaters in the US. In March 2020, it announced the closure of all its theaters due to the COVID-19 pandemic. This was in compliance with CDC guidance against any gathering of over 10 people. In June, AMC stated that it had substantial doubt that it would remain in business. In August 2020, it began the process of reopening selected locations in the US. The company upgraded its air filtration systems to 4 times the rates before the pandemic and installed electrostatic sprayers in the auditoriums. In October 2020, the company reported that its existing cash resources would be largely depleted by the end of 2020 or early 2021. In January 2021, it raised $917 million in new funding, including $506 million in equity and commitments for $411 million in debt financing. The company stated that this new funding should allow the company to make it through this dark coronavirus-impacted winter. The next day, as part of a wider series of short squeezes coordinated by the Reddit community and Wall Street Bets, AMC experienced a 300% surge in its share price to a peak of $20. The surge triggered $600 million of its debt holdings to convert to equity at $13.51 per share. As retail investors poured into AMC stock hoping to cause a short squeeze, AMC issued more shares. They said only invest if you are prepared to incur the risk of losing all or a substantial portion of your investment. Even though the stock was trading 8 times higher than ever before, analysts saw the stock as worthless due to the company's stock dilution, poor earnings, and massive debt. Retail investors have gone bananas for AMC, but they will use deceptive tactics to attract fresh capital. Pump and dumps usually end badly for most of the parties involved. AMC has become a battleground pump and dump scheme driven almost entirely by the misinformation and lies spread by retail investors. The big lie is that hedge fund short selling can bankrupt businesses. The operating performance of a company determines whether or not it thrives or goes under. There are plenty of companies whose share price are under $1 that aren't bankrupt. And there are companies with share prices north of $1 that ultimately file for bankruptcy protection. Investors who choose to buy or short sell stocks are simply betting on an outcome. They don't control or influence how well or poorly the underlying business performs. When Warren Buffett buys $1 billion of Apple stock, that may help improve its share price, but he did not improve the company's sales or profit potential. If a hedge fund shorts Apple $1 billion, that has no effect on Apple's future sales or profits. This scenario works for any company, not just Apple. Additional misinformation from apes is that short sellers of the stock have to cover. Specifically, apes are implying that there's some level of urgency here and that the disorder from excessive covering will lead to the mother of all short squeezes. The truth is that short sellers have to cover as much as apes have to sell their position. In other words, short sellers can cover their position at their leisure. Hedge fund assets under management is $4 trillion. For the stock to drastically increase, a massive wave of margin calls would need to occur. Since the vast majority of hedge funds are diversified and well-funded, the chance of a margin call wave forcing short covering is unlikely. History shows that short squeezes are not common. Lots of stocks are heavily shorted, and rarely is a stock driven up more than 10%. as the result of short sellers covering their positions. Also, the apes claim bankrupting a hedge fund is a win for the small investors. Even if you bankrupt one or two hedge funds, there are still 3,600 other ones in the US. So there are plenty of other companies to pick up the pieces and continue shorting the stock. Let's get started with the model. This is a large cap company, 18 billion market cap. They're trading at $35 a share and they have 513 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they only had positive free cash flow in 2019, negative in the other years. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's positive in 2019, negative after that. Revenue is a sales for the company, and that drops a ton from $5.5 billion to $500 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that dropped about 90% from $3.5 billion to $300 million. Below that is their operating expenses. And they weren't able to cut their operating expenses as much since some of them are fixed. So they had a pretty big negative operating income in 2020 and the trailing 12 months. They paid over $400 million of interest on their debt, which is the most they paid in a 12-month period. They had some really large asset impairments in 2020 and the trailing 12 months. An asset impairment is when you decrease the value of an asset on your balance sheet and pass through the loss onto your income statement. So if the value of real estate decreases, you would decrease that amount on your balance sheet, and that would affect your net income. So their net income looks really bad in 2020, but in 2020 they didn't lose $4.5 billion because an asset impairment is a non-cash item. I'll show you on a statement of cash flows what I mean. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. So they only lost $1.1 billion of cash in 2020. That's still a lot of cash to lose, but it's much better than $4 billion. They were generating positive operating cash flow in 2018 and 19, but they're constantly putting money back into the business, opening more movie theater locations. They invested over $500 million in CapEx in 2018 and 19. If they purchased the real estate for a new location, that amount goes into CapEx and is depreciated onto the income statement over 10 or 20 years. Operating cash flow minus CapEx gives you your free cash flow. And they do have negative free cash flow every year except in 2019, they had a small positive. So ever since the pandemic started, they used a lot of debt to fund their business because they had a big negative in operating cash flow. They added $1 billion of debt in 2020 and $1.7 billion in the trailing 12 months. In 2018, it looks like they added about $500 million of debt, but they used that debt to pay down capital stock. That's not a good use of debt because when you add debt, you have to pay the interest payments on your debt. Paying down capital stock is okay if you have the additional funds to do so. It looks like they issued that debt to buy back $421 million of stock from Wanda. Wanda is a Chinese company. They're the biggest shareholder. They own over 50% of this company. And they bought back the B shares. Each B share gets 3 votes. The A shares, which you can buy in the open market, get only 1 vote. This is pretty common. A lot of companies issue B shares, so it keeps the voting rights within the company or with the biggest shareholders. So when this Chinese company invested in AMC, they wanted voting control. So that's why they got all B shares. This is the equity section of the company's balance sheet. And they have negative $2.3 billion of equity. They raised $3.7 billion by issuing stock. But you would hope they would take that $3.7 billion and become a profitable company. But instead, they lost about $6 billion. Retained earnings is a sum of all your prior net incomes. So overall, they're losing money as a business. So this is why short sellers thought this company would go bankrupt, especially during the pandemic. The company was already struggling and all their theaters were shut down, so they just figured this company was toast. But I'm pretty sure eventually the company will go bankrupt because no matter how much you manipulate the stock, If the company can't pay its interest payments on its debt, which seems like it may happen any day now, it will have to file bankruptcy. Just because a company has negative equity doesn't mean the company is struggling financially. This is Boeing's balance sheet, and they have negative $18 billion of equity. So when you just look at the equity, you would say Boeing is doing much worse than this company. But look at Boeing's retained earnings. They actually had a profit of $38 billion since they started as a business. That's a lot of profit. And they raised just $7.8 billion in capital. So investors invested $8 billion into the company, and the company provided a $38 billion profit. That's pretty impressive. But the reason they have negative equity is because they bought back $52 billion of stock. So when they had extra cash, they did pay a dividend, but they didn't want to pay a 10% dividend, so they just bought back stock. That kind of keeps the control within the company, because if a company pays a dividend, it can't get the money back from the investor. But if a company buys capital stock, which they did, they can just reissue the capital stock if they need money. Also, investors are better off tax-wise when a company buys back stock than pays a dividend. And the reason this number is negative is because treasury stock is a contra equity account. So if it's positive, you minus it. So 5 billion plus 8 billion plus 38 billion minus 17 billion minus 52 billion. You can't add it even though it's a positive. You have to minus it. Since it's a contra equity account, it acts the opposite of a normal equity account. There's also contra asset accounts like accumulated depreciation. So don't just assume negative equity is a bad thing. Anytime you see a number, don't just assume that's good or bad. You have to look beneath the curtain and try to figure out if it's really good or bad. Let's look at the capital structure. They have negative $2 billion of equity, $11 billion of debt. So they're 100% debt, 0% equity. And their weighted average cost of capital is 9.15%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4. That's $3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.5 billion. We divide that by 513 million shares. We get a calculated stock price of $3. They're trading at $35, so they're trading at 1,100% premium. It's a sell according to the model. I don't think the company will ever become profitable, but I just gave them the best situation where they would become profitable in 2023. Even in the most generous scenario, I'm still coming out with a stock price a lot lower than they're trading at. Simply Wall Street is a lot lower than me. They're at 18 cents a share, so they're saying the stock is even more overvalued. 6 analysts priced this stock, and the average price target was $6. The low was $1, the high was $16. This is where the stock has been trading since 2013. So you can see the stock was doing well in 2013, 14, 15, and 16. Then it started a steady decline. But then the short squeeze pushed the stock higher than ever before, even when the company was doing its worst. This is where the stock has been trading the past 12 months. So the first short squeeze, the stock tripled to $20. The most recent short squeeze, the stock got up to over $60 a share. It's come down since then, but who knows where it's going to go. It could get pushed up to $100 a share, or it could go to zero. It's anyone's guess. And their beta is not too high. It's only 1.34, so the stock isn't too volatile. The stock has gone up 7 times in the past 52 weeks, while the S&P 500 only went up 33%. The 52-week low was under $2, and the high got over $70 a share. And the stock is trading above its 200-day, but below its 50-day moving average. And this is one of the most liquid stocks in the market. Over 100 million shares are traded each day on average. Of the 513 million shares outstanding, 448 million are on float. 23% are held by institutions, and over 15% of the shares are shorted. With the recent short squeeze, the stock is up a lot in the past year and past 3 years. But even with all the short squeezes, the stock is not doing as well in the past 5 years relative to its industry and the market. Analysts are forecasting their earnings to grow more than its industry and their revenue to grow more than its industry, probably because their revenue and earnings are so low. They do have a lot of room to grow. In the past 5 years, this stock has really struggled. Its annual earnings are down 77%. If you invested $10,000 into this company when it IPO'd, you would have been down to under $1,000 at one point, but with the recent pump, you'd be at $26,000 today. That's a 13% annual return. Earlier, I mentioned a Chinese company owns half the stock. They own the B shares, and the B shares are not traded in the open market. So all these numbers are based off of the A shares. So Vanguard owns 7% of the A stock, then BlackRock, Invesco, State Street, and Geode. They don't bring in much sales at this point with COVID, so they have a pretty bad price to sales ratio. And we can't look at the price to book because they have negative equity. When a company has negative equity, that means its liabilities are greater than its assets. They can only cover 60% of their current liabilities with their current assets. Same thing with the quick ratio since they have no inventory. They do have $800 million of cash on their balance sheet, but they're still underfunded. In the past 12 months, they had negative $1.4 billion of free cash flow and negative $569 million of working capital. So they're short about $2 billion, so they're going to need more funding to run their business over the next 12 months. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 6 other companies in the same industry as AMC, and AMC is worse than the average in every single category. We can't look at their PE or price to book. Their price to sales is worse than average, current ratio is worse than average, they're 100% debt. They do have a pretty big market cap, but it's still much lower than average because Disney and Netflix are in this industry. So to summarize, I have them trading at a significant premium. It really seems like this company is doomed. They're in so much debt and they're not profitable. I don't think they have a terrible business model, as some people say. I miss going to the movies. At least in my lifetime, I don't think anything can take away the experience of going to the movies with friends or family. So even if this company were to go bankrupt, movies will still be there, and there will always be movie theater chains. I just think they have so much debt, they have such a big hole to crawl out of, I don't think they can make it. Unless, of course, they get into other industries, because they need to bring in a lot of cash to pay down the debt, to just get their head above water. It is really impressive how the retail investor was able to inflate this stock price so quickly. It can't last that much longer unless the company turns it around big time. But if you made a good profit, I would get out, because I'm not sure how long this company can stay in business. But I've been wrong before, so don't quote me on that. I rank their free cash flow as 1 out of 10, their revenue 1 out of 10, and their ratio is 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.